Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor. I'm speaking to you on Tuesday, November 11th, 2016, just 1 week before the presidential elections. I'd like to remind you that I am also the author of a newsletter, Jay Taylor's Gold, Energy, and Tech Stocks, and my partner, Chen Lin, publishes What is Chen Buying, What is Chen Selling, and you can sign up for both of those letters by going to miningstocks.com. You can also keep up with a lot of very interesting articles that pertain to the gold markets and other financial markets. I have links to those articles at miningstocks.com, and if you're a subscriber to my newsletter, you can also keep up with the latest information and news releases for all the companies that I cover. I also provide links to those press releases as well at miningstocks.com. I'd like to thank our sponsors for making this show economically viable. For today, our sponsors are Novo Resources, Klondike Gold, Aran Resources, and Ariane Phosphate. Now, both Novo Resources and Klondike Gold have had some very interesting assay reports today that you can read by going to miningstocks.com. Click on the links. We'll be talking to Peter Talman. He's the CEO of Klondike Gold. Peter will be with me in just a few minutes after our first commercial break today. But before we get into today's show, I'd like to tell you that Novo Resources, just to give you an idea, some really impressive results. 59.1 grams of gold, the best intersection. That's almost 2 ounces of gold over 2.5 meters. So very, very impressive, and a lot of other impressive assays as well. Intersections reported today. Also some very good antimony readings in a couple of those drill intercepts as well. We'll be talking to Dr. Henning pretty soon, one of these days in the near future, to give us an update on Novo Resources' very exciting gold exploration play in northwestern Australia. Today's show I've titled, Can America's Superior Military Perpetuate U.S. Dishonest Hegemony? I always mispronounce that word, hegemony. As I noted, Peter Talman will be with me in just a couple of minutes, and David McElvaney will be with me at about 1:30, and Michael is waiting to give us his latest ideas and his latest results about the work that he follows, the markets that he follows in just a second. Just a word about today's show. As American bombs kill thousands of people and displace millions of refugees, hatred towards NATO and the United States is most certainly on the rise, and we've seen that expressed certainly in amongst the new Philippine president, who's called our president some pretty nasty names. I suppose a lot of Americans have too, but nonetheless, for foreign leaders to call the president of the United States very unflattering names is something kind of new. And then we saw President Obama snubbed, of course, also at the G20 meetings, or when he was attempting to get off his aircraft there. The Chinese not only did not give him the red carpet, but they basically denied him access, and the president had to get out through the back of the plane through some sort of makeshift staircase or whatever is used. But anyway, unceremoniously received in China another snub. In the meantime, as we've talked to frequently on this show, we've talked about the new Silk Road that's linking China, India, Russia, all the way to Eastern Europe. And it just seems to be a growing picture of economic strength from rivals and rivals to NATO, which is threatening the U.S. dollar reserve currency. We talked to Mr. Rickards about that in the past and expect to have him on in a couple of weeks again to update us on some of these geopolitical events and how they impact the financial markets. Well, NATO seems to be countering this threat from the BRIC countries and others by surrounding Russia right now with troops, and I believe sending the world closer to a nuclear war than any time since perhaps the Cuban Missile Crisis. That's not my view as much as it is experts on the topic. But the question that we pose today, can military might alone save the dollar? And we'll ask David McElvaney to opine on that. And what the outcome might mean for gold and other markets when we speak to him. But right now, I'm really pleased to have Michael Oliver, who certainly would have opinions on all of the topics that we're talking about today. We usually talk to Michael mostly, though, about technical work because that's what he's known for. It's not to mean he doesn't have very well-informed opinions about fundamentals, but his work and his reliance on technical analysis has been so helpful to us and so many other investors that we're really always honored and pleased to have Michael with us. Thanks for being with me again today, Michael.
Always glad to be back, Jay.
It's always good to have you because I really see you as an objective thinker, as one that lets the markets do the talking. You know, us guys that look at things from a fundamental perspective, oftentimes, you know, we think we know what the markets should do. It's such arrogance in a way, isn't it? I mean, how can any one person or any group of people actually be smarter than the collective wisdom of markets? And I think what your work is showing is that that's simply not true, the collective wisdom of markets, but it's also in your ability to read those markets and do so accurately from what I can see, and I've been following you now for 2 or 3 years. I don't know of anyone who's done a better job, at least from my perspective, not as a day trader, but as a longer-term investor. So I want to ask you, one of the most important markets, if not the most important market in the world, is the U.S. T-bonds. And you have been talking recently through September and October, you've been talking about a break below 166 would be a pretty serious break. And in fact, I looked a little bit ago before we went on the air, Michael, and the T-bond was at 162 and 30 seconds. What is your read on this? Are you pretty confident that we're heading for higher yields now, lower prices on the T-bond?
Yeah, and not just the T-bond, but the other developed economy government debt markets, the Bunds in Germany and the JGBs in Japan. And also, I'm particularly focused on the Italian yield situation, Italy being like 10 times Greece in terms of lethality and size. Mm-hmm. Its yields have been in major decline for several years, and that's due to the ECB literally driving the yields down arbitrarily to the point where their 10-year Italian yield was below that of the U.S. 10-year, which is ludicrous, of course. It's starting to turn. The yields are turning, but more importantly, I have, if you close the week out, this is only Tuesday, but if you close the week out where we currently are, or anywhere close to where you are right now, in Italian 10-year yield, the momentum of that chart breaks through a 4-year wide base and says to me, this rise in yields is for real. In other words, it's coming unhinged. So all of the efforts of Draghi and the ECB to artificially price money in Europe or debt instruments, it's coming undone. And Italy is the place to watch because, again, it's 10 times Greece. So remember, Greece back in 2011 was the focal point of the world and shook everything. And now I think maybe it's Italy's turn. Our bonds have broken. In my opinion, the annual momentum trend of the Treasury bond market is over. It's down. Yields are going to rise. Prices going down. But I throw out this caveat. I think it's best, that piece of information is best used not as a medium to trade in, to go short the T-bond futures, because I think there's a risk, and we're seeing some of it today, where if the stock market breaks sharply because of the rise in yields and other factors as well, unjustified price levels, for example. But if the T-bond market's downside or upside in yields rattles the stock market enough, you're going to have flight to safety. And that's going to, if you're short T-bonds, you could get hurt. So I think the main point of the T-bond top, the rise in yields now in bonds, is that information should be applied to other asset categories. I think it reinforces my assumption that commodities are turning up. Okay, so we're getting inflation in the commodity end, we're getting rise in yields, and that should net on balance definitely hurt the stock market. I think we're seeing evidence of that in the last several months, and particularly today. So, it's a big piece attached to other pieces, and I think, yes, T-bonds have topped, yields are going up, but it might not be an easy ride if we get a sharp stock market sell-off in the middle of that.
Right.
Because, again, the flight to safety.
Flight to safety, and as long as the U.S. dollar is considered to be, the world's reserve currency or a major currency for global trading, that will continue to be true. I guess it's only at some point in time when and if the U.S. dollar is no longer considered to be a safe place to go to. It's hard to see that happening right away, but of course that is one of the overall topics of our show.
The dollar index, which measures against the euro primarily, 57% to the euro, and then the yen and the British pound and so forth, is breaking down. right now. It broke down several days ago, according to my work. Not a major break. The major break in the dollar index, which is now under 98 in price, in the 97s. If it gets in the high 95s, which is just 2 points below where you are now, that's for the dollar index at 2 points is a distance. But if you close a month out down there in the 95s, you're breaking massive uptrend on annual momentum, which says the dollar's really going down, which could contribute again to what? Stronger commodity markets.
Yeah, exactly. And you know, Michael, we hear all the time, the mainstream media is always telling us and wanting us to believe that the Federal Reserve is in charge of interest rates. The Federal Reserve is our God. It provides all our needs. We don't have to worry about anything because Ben Bernanke or the lady in charge now, they all know what they're doing. You know, I have to think, though, that as I was reading your weekend missive here, you know, we've got interest rates on the rise. We've got commodity prices rising. Your work is suggesting that we're in for a commodity price rise, and so the two are not unrelated, are they? So what's really driving these rates higher? Is it really the Federal Reserve chiefs, or are there other? You know, is the market in charge? Is the Fed in charge? I guess is the question.
I think the markets are taking over everywhere, and I think the central banks are losing control. And I think that Italy chart, I issued a report today, and I think that's one big raised finger that says you're not in charge anymore, Mr. Draghi. And similarly here, I don't think the Fed wants rates to rise sharply, and I'm talking about a sharp rise. I'm talking about the 30-year bond, which had been loitering around 2.5% or lower for months and months, could go up to 3.5% to 3.7% rapidly. That's earth shaking. And that's not caused by the central bank. They're at the short-term end of the debt market, you know, the overnight rates and things of that sort. So what goes on in the 10-year on out, they don't really control that well. And I think they're losing control, basically, of everything. Is more and more doubt, even among people who aren't of, let's say, free market orientation, are coming to realize that they've distorted things. Pricing levels of all kinds of assets have been distorted, either too high or too low, other than where they might otherwise be, and that this is coming undone.
Well, we just need smarter people from Harvard, Princeton, and Yale, Michael.
Yeah,
that's all.
That's all.
I mean, we just haven't gotten quite the right person in charge yet. But let me ask you this, Michael. You know, you talk about the commodities on the rise and gold leading that charge. Do you think at some point in time it will be gold that leads the commodity complex down? I know we're early here. You feel that we're very early in these moves.
Yeah. Gold does tend to lead tops and bottoms. That is a true statement. In 1980, when gold peaked, it peaked in January. Oil, for example, peaked in October. Commodities in general didn't peak till later in the year. The bottom in 1976 in gold was 1 year ahead of the bottom in the commodity index. So and recently, February, gold broke out in on our reports. We issued a report at the annual momentum had broken out in gold. This is in February. Oil, to some extent, followed in April, but basically most commodities have not yet really surged. We think the back end of the commodity complex is about to do that, the grains in particular. And so, gold tends to lead. But I don't think we're anywhere near the top. That's probably years away and many thousands of dollars away.
All right. So the last we talked, you were still looking for, the first major resistance for gold in the high 1400s. That's still your that's still your belief.
Moment, it may change next year. Some of the numbers will change, but it was the high 1400s, low 1500s. And today we're surging up into the high 1290s. As far as I'm concerned, the action today in gold and the action in the GDX, which is the gold miners ETF, unleveraged ETF, today is pretty definitive in saying the following. You've seen the low. Now, the nature of the recovery from that low that occurred early in October, it could be zigzaggy, but that the low is in place. I feel fairly strongly that was the end of the corrective low.
All right. Well, we'll have to leave it at that. Thank you so much again, Michael, for your insights and and for helping us see forward as best we can. You're always appreciated. Thank you so much for being with us, and we'll look to do it again.
Thank you.